Just a quick disclaimer to this. I'm actually really unbiased towards the whole trading algorithms. I don't really know a whole lot about the stock market, so a lot of this was prior research.
So what is an automated trading algorithm?
Parameters identified at expect 1% gaps and 3 to 5% corrections. Current volatility is at low and current expected is currently at an all-time low at 0.5%.
NASDAQ dropping 15%. Abort. Mayday. Get in trade.
So as you can see, they're not really that complicated.
Algorithmic trading is the process of using computers pre-programmed to follow a defined set of instructions for placing trade orders to generate profit at high speeds and frequencies that would be otherwise impossible for humans. There's a couple things we have to understand first, that there's a difference between algorithmic trading and automated trading, but they can still work in tandem. Algorithmic trading uses computer software to calculate information about orders such as price, the timing, and the quantity, whereas then manual human traders can then authorize any calculated trade by the software. So not all algorithmic trading is automated. However, automated trading refers to a fully automated computer process, where computers are linked to market data, which are able to read and process this data and feed it into an algorithm. If the algorithm likes what it sees, it completes the trade. These trading algorithms are the birthchild of market experts and programming nerds. The core functionality of these algorithms is to produce the most efficient trading scheme, pretty much to buy low and sell high. But they can do a lot more than that. As of today, roughly 90% of the volume in public equities is traded algorithmically. Wow.
So the main question here is this okay, letting the computers do all of the trading for us? Well, I don't see why not. There's a ton of benefits that come with these algorithms.
The main benefit to these algorithms is it takes the dirty work out of market observation. Traders can just sit back, sip a hot coffee, and let the algorithm do all the work for them and raking in huge profits.
Well, kind of, sorta. They still have to pre-program these algorithms and give them specific parameters on what they want to do with the market.
And what's great about these trading algorithms is it completely takes human emotions out of the equation, or algorithm, should I say. Because as we all know, humans easily can make mistakes, and when trading on the stock market, you can hesitate and accidentally pull the trigger, or you're afraid to pull the trigger. This can lead to overtrading, which is buying and selling at every perceived opportunity. Since computers don't have emotions, overtrading generally won't happen with automated trading systems. These computer traders cannot make guesses. It has to be told exactly what to do and when to do it. But what's nice about this is that these algorithms can be back-tested. Traders can take precise rules and instructions for these computers and test them on historical market data to determine the viability of the trade. You can think of it like a proving ground for the algorithm to test its capabilities. This is why traders love backtesting, because they don't have to risk their money on the live market. Another huge advantage to these automated trading systems is its ability to preserve discipline and achieve consistency. Once again, pesky human emotions can get in the way of a successful trade. Discipline is often lost due to emotional factors like taking a loss or the fear of taking a loss, or trying to squeeze a little bit more profit out of the trade. So if we have the ability and the knowledge to make these very impressive automated trading algorithms, why wouldn't we want them? Wouldn't we want to not be stressed out trying to make decisions based on a live market? So many other jobs have already been automated, and it would make sense to have computers handle one of the most psychologically taxing jobs that a human can do for a living. One example of this psychologically destructive job of trading is the story of Mark Barton. Mark Barton was a day trader at an Atlanta, Georgia trading firm. As he was working in trading, Barton became paranoid and started distrusting his wife, and he lost his job when his work performance was suffering. He was actually caught sabotaging company data in retaliation for his firing. After he spent some jail time, he got a new job at another trading firm, but he also started having an affair with one of his wife's acquaintances. His first wife and her mother were bludgeoned to death in 1993, and Barton was the prime suspect, but he was not accused due to lack of evidence. He remarried 2 years later, but his mental health continued to deteriorate, and he began to suffer from severe depression and paranoid delusions. Barton also received a huge $300,000 insurance settlement from his wife's first death, and of course he used these funds to invest in high-risk stocks. His investments failed, and Barton ended up losing about $105,000. 1 month later, Barton went on a killing spree, bludgeoning his second wife to death and his 2 children, and killing about 10 other of his co-workers. And before the police could get to him, Barton committed suicide.
Okay, so that was pretty dark. I just wanted to talk about that as a point of an extreme case where huge financial loss can negatively affect a person's mental condition. I just really wanted to get the point across about how stressful being a trader can be. So in a perfect world, these trading algorithms and automated trading systems make the lives of traders a lot easier, but they don't come without a huge set of risks. Mechanical failures, unreliable networks, glitches in the system, over-optimization, all of these are issues that can come with automated trading. Just an example of one of these glitches that an algorithm can run into was this story about Knight Capital, which was a trading firm. They lost $440 million due to a faulty test of new trading software. So basically what happened with this algorithm is that on the stock exchange, there's a bid price and an ask price. And the bid price is what you'd like to pay the holder of the stock. And the ask price is what they'll pay to buy those same shares from you. And there's always a spread between these prices, usually a few cents, maybe up to 20 cents. And the software kind of mixed this up. It actually ended up buying at the ask price and then selling at the bid price. And with a spread between the bid and the ask price of about 15 cents, say for an IBM stock, it's doing about 40 trades per second and taking 15 cents per share loss. That's a very efficient money burning system. So this was just an example of anything that can go wrong might go wrong, and it would be catastrophically bad. This absolutely crippled Knight Capital and put them at the brink of insolvency. Something else to keep in mind is that these computers and algorithms only look at numbers. They only look at numbers on the market. They don't know what's going on in the real world. They don't know political issues, environmental issues. So some may argue it's bad to let these things operate freely on the market. We all know that computers don't work 100% of the time, all the time. Another disclaimer is that I don't know a whole lot about the world of automated trading algorithms and the stock market overall, so I had to do a lot of research prior to this. Hopefully you all learned something about the world of automated trading algorithms. I know I definitely learned a lot myself, and maybe you were able to understand kind of both sides of the debate about why these can be good for the economy and or possibly catastrophic